If you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to the Morningstar series, Market Reaction. I'm Emma Wall and here with me today is Stephen Bell to give his views on the latest inflation report. Hello, Stephen.
Hello.
So what exactly did Mark Carney have to say for himself this time around?
I think the interesting thing about, he changed a lot of economic forecasts, he gave some new assumptions, there were new members of the committee, deputy governors there. But actually, I think his principal objective was to try and lose this epithet of the unreliable boyfriend. It was a great phrase that was hurled at him by Pat McFadden at Treasury Select Committee. And it's not the sort of thing a central bank governor wants to hear. And the reason for that is when he first arrived, his big thing was forward guidance. It cut rates, it got everybody feeling dovish, and he was on that side of pushing expectations of interest rates lower, currency went down. And then suddenly, in the Mansion House speech, which was a massive occasion, he totally outshone the Chancellor, and he seemed to say rates were going up earlier than you thought. And then, a few months later, he was dovish again. So he was changing his mind, and people don't like that. There's nothing, hell hath no fury like an analyst made wrong. So today, he used the words boring and consistent, I don't know, a dozen times? I mean, more often than the word inflation, I feel. So what they've done is said, I mean, let's be honest, nobody, including the bank, expected unemployment to fall this far. It's been great. But given the fall in unemployment, it's inconceivable that anyone could have projected that wage inflation would actually decline. And at Christmas, there was some survey data showing wage inflation was going up, and it all seemed consistent. Unemployment falls very strongly, the economy suddenly strengthens. What's the next thing? Well, wage and price inflation. The survey data, which shows you the kind of settlements that firms are about to do, and if settlements double and it takes, everyone renegotiates once a year, it would take a year for that to show up in the official figures for average earnings. But in fact, although that data suggested they'd go up, they've actually gone down. So there's no wage inflation, massive absorption of employment. I mean, the data today showed only 167,000 new jobs, which was a bit lower than expected. But I mean, that's still a huge number. And the increase in employment has been staggering. So he's got to accept, in fact, one of the questioners from the press said, between certainty and cluelessness, aren't you in the cluelessness camp? So he's got a kind of small but growing credibility problem. As far as the economy is concerned, it's not a bad thing that unemployment falls and inflation and wage inflation is obviously, you want to get a wage rise, but people at least getting a job. So the response to the inflation report was people expected interest rates to rise more slowly. The exchange rate went down, which would help manufacturing, and the stock market went up. So, you know, what's not liked about that?
Well, apart from wage inflation isn't going up at the rate that people would like. I mean, when Mark Carney came in, he was, as you say, very much a hero of the markets, a hero of the economy for creating some sort of stability. Now that's gone away. Wage inflation has been downgraded from 2.5% to 1.25%. What has to happen for interest rates to rise? Does wage inflation have to come up? I mean, what is next for Carney?
Well, that's the $64,000 question. And the answer he gave, actually, is something that I don't think got enough attention. He said it's prospective wage inflation. So wage inflation today came out at an extraordinarily low level, record low level. If it goes up a bit, I mean, wage inflation could go up to 3%, 4%. And if we had a bit of productivity growth, that would not be inconsistent with a 2% inflation target. But if we get that momentum and it looks sustainable, then they raise rates. But for the moment, wage inflation just is not going up. So that's the critical thing. Now, there's a similar problem across the Atlantic. Janet Yellen is also got it all wrong. She had her own forward guidance, similar, in fact, to Mark Carney's, and she's also had to abandon that. The difference is that in this country, there's a pretty close link between wage inflation and service sector inflation. Obviously, manufacturing goods inflation is very much a function of exchange rate, but we can measure that as well. So you put those two together, and you have a pretty good idea about inflation. In the United States, the link's not quite so close. It's a different market. So here, where we've had, this dramatic decline in unemployment, maybe unemployment keeps on going down, which would be great news. The last big recession, 30 years ago, you got a pay rise, but you were out of work. So it's a different dynamic. There was much more misery involved by people being unable to get a job, but those in work were all right. With the current labour market, where if you want a job, you can get it. It just may not be as many hours, or indeed as much wages as you want. So I think in terms of the overall macro balance, it's not bad. And the other thing, of course, the thing that is always obsessing people in this country is the housing market. And to some extent, he's also taken action on that by keeping interest rates low, by promising to raise them gradually, which he kept on saying. He depresses interest rates averaged over 1 or 2 years, which is what price mortgages now. But he's taken action on that by requiring lenders to check that you can afford a 3% rise in base rates. So he's telling everybody, it's not a guarantee, it's more like a promise that he won't raise interest rates by 3% in an extended period, but he's requiring mortgage lenders to make sure that if you want a mortgage, you can afford it. So he's kind of taken action to restrict excessive lending so that he may not have to raise interest rates. And this sort of macro-prudential measure is a new development for central banks. He used it in Canada. He's imported that successfully. They've used it in other countries. And I think to some extent that helps the lower for longer and not too high when they raise rates. So, he has to accept he's got it wrong, I've got it wrong, no one forecasts this development, but he's trying to reassure people. And I think his key message now is consistency. He doesn't want to be seen as unreliable.
So do we completely forget everything he said a couple of months ago about slowly but surely going up a quarter of a point every quarter?
Well, he did actually quote, having said he wouldn't comment on market interest rates. He said market interest rates have less than a quarter. They actually have a rise to a little bit over 1% from 0.5% base rates now to a little bit over 1% at the end of 2015. Well, I mean, people like me remember the days of 3% rises in a day. That's very slow. And he won't comment on the timing because he doesn't know. And he's got the November inflation. They really are very unlikely to make a move except around an inflation report. That's when they get all the data together on that. And they're twice as likely historically to move on an inflation report month than any other month. So let's assume it's November, which is the next one, or May. In fact, they had to change the day of the May meeting until the day after the election because it was going to be the day before, which wasn't really ideal. So it's one of those. Probably not November now. Maybe May. Maybe February. We don't know. But it's one of those days. And it all depends on wage inflation.
So watch this space.
Exactly.
Stephen, thank you very much. This is Emma Wall for Morningstar. Thank you for watching.